Hi, my name's Jeff Greenspan, and I'm Managing Director of Financial Modeling Service. Today we'll be talking about analyzing real estate like the pros. Real estate is an asset class that provides a number of specific time-based and tax-based advantages, but it can be complex to model. We'll be talking about all of these items today. Unlike investments in the stock market, you can often estimate the future cash flows of a real estate investment with some precision. This, of course, requires financial modeling. So let's get started. Some of the advantages of real estate are the time value of money. Specifically, money that you spend on a loan in the future is worth less than money that you spend today. Leverage, which is often in the range of 70 to 80%, allows us to increase our returns on investment. There are significant tax advantages with real estate. Almost every form of real estate ownership has tax advantages, with the tax treatment of depreciation being the most commonly cited. Income generation, of course, the stability of cash flows as compared to the volatility of the stock market. Diversification, obviously, as an investor, you can't put all your eggs in one basket. And lastly, inflation hedge. Because real estate is real property, it tends to increase in value over time along with the rate of inflation. Disadvantages, however, because it is considered less risky, because it's real property, sometimes the overall returns may be less than investing in the stock market. I have not necessarily found this to be true in my own investing. Key disadvantage, though, is illiquidity. Real estate cannot be bought and sold on a dime. It takes effort to buy, it takes effort to sell, and the general word in the market is you make money when you purchase, not when you sell real estate. Real estate is very location specific. Each property is unique, and it requires some level of management. Even if you're not the person doing it, somebody has to manage the property. Tenants and toilets. You have to deal with people, and you have to deal with maintenance. Finally, some of the long-term risks of real estate include shifting demographics and changing preferences, which can affect your ability to generate returns on a particular property. All real estate models are designed to estimate future cash flows. Some models are simple, some models are complex, but we need to know what we're talking about. So let's define the terms that we're going to be using. Potential gross income, or PGI, is the total income that a property can generate if fully rented. Vacancy losses occur when you don't have full rentals or when you turn over properties. Somebody leaves, a property needs to be fixed up, a new tenant needs to be found. This is commonly estimated in models as a percentage of the potential gross income. Miscellaneous income is any non-rental income generated by the property. Could be pet fees, laundry room, snack machine, whatever you've got, parking, storage. These are miscellaneous income fees. And effective gross income is calculated by subtracting the vacancy loss from the potential gross income and the miscellaneous income. Operating expenses are those expenses required to run the property as a business. There are fixed expenses like real estate taxes and insurance, and variable expenses, which include quite a variety of potential additional expenses. Depreciation is a key term when investing in real estate. Depreciation is an annual tax deduction that reflects the wear and tear of regular use, but it's not an actual outgoing cash flow. This particular expense needs to be recaptured when the property is sold, and you will pay taxes on recaptured depreciation. Nonetheless, depreciation amounts to a tax-free loan from the government and becomes more valuable over longer periods of time because of the time value of money. Next, we talk about net operating income, which is the income left over after all operating expenses have been paid. Net operating income combines with the cap rate to determine the price of investment property. We'll talk about that in a moment. Capital expenditures are capital or cash required to improve the property. CapEx is distinguished from repairs and tax treatment, and so it requires a separate line in the model. It's often referred to as a below the line expense because it's not included in net operating income. Most owners prefer to allocate money that goes into the property as an expense, and this is often allowable. You may need to talk to an accountant about the difference between a repair expense and a capital expenditure. Finally, cap rate. All properties are unique, so to make some reasonable comparison between properties, investors consider the ratio of the property's first-year net operating income to its purchase price. This ratio is called the cap rate. Let's take a look at cap rates and how they affect property values. In this chart, we see a property with net operating income of $100,000. Depending upon the cap rate, the property value can change significantly. At a cap rate of 5%, the property is worth $2 million. At a cap rate of 10%, it's only worth $1 million. The reason for this, the change in cap rate, is the stability or the volatility of the net operating income. If you have a property with a Class A tenant that you know is going to generate net operating income of $100,000 per year, pretty much guaranteed, the rate of return that you will expect on that property is less than if you have a property where you have a tenant who may not be able to make the payments on a regular basis or whose payments may fluctuate over time. That property is less value because it is riskier because of the volatility of the returns. Okay. Our first step is calculating the net operating income, and the basic calculation is simple. The potential gross income less the vacancy plus the miscellaneous income is equal to the effective gross income. From the effective gross income, we need to subtract the operating expenses associated with the property. I've listed some potential operating expenses here, but it's critically important that you understand what the expenses of a particular property will be, and that often requires research. I call the insurance agent to check to see what my insurance prices are going to be. If someone else is managing the property, I would like to see a proposal before I actually purchase the property. And some of these other values you should be able to get from the existing owner of the property. How much are they spending in landscaping, trash collection, utilities? Legal and accounting is probably specific to you personally, so you should understand what those numbers mean. Also, let's take a look at our spreadsheet here because I've got a note here under real estate taxes. This is an area where you need to be particularly careful. I usually estimate real estate taxes in the first year after sale based on the real estate taxes on the property before sale. However, many jurisdictions update their tax records after a sale. So in the second year of a property, I will base the taxes on the actual millage rate of the property. In this particular case, we have a property that's worth $1 million and the building cost is $850,000. That is the cost that is typically used to assess real estate taxes. I looked up the millage rate for Alachua County, which is where I'm sitting, and it's $7.89 per $1,000. So in the second year of the property, I will calculate the real estate taxes based on the millage rate and the assessed value of the buildings. After that, I might assume a 1% increase per year. You'll also notice as we calculate the net operating income that I have a number of parameters for entry, and this can get very complicated depending upon the type of property that you're in. I'm assuming rental income growth increases of 3% per year, and that other income will increase at 1% per year. I'm assuming a 5% vacancy collection loss. I'm assuming that real estate taxes will grow 1% per year after the third year. I'm assuming the property will need fairly significant repairs the first year, with those repairs decreasing over time and stabilizing at 1%. I'm assuming that other expenses will grow at a 2.5% rate, and I'm assuming that management fees will be 6% of the effective gross income. With that information and an estimate of what my potential gross income in the first year and miscellaneous income in the first year might be, I can build out a net operating income statement. And you can see that we have different levels of net operating income over time. I've run out through the 6th year, even though my model is a 5-year model, because of the way that the terminal cap rate comes into play. We'll talk about that in a moment. Now we're ready to take a look at how we account for taxes and annual cash flows. You saw the net operating income of the first 5 years. And so in this model, I'm assuming that we're going to sell the property after the 5th year. In almost all cases, I tend to be a buy and hold investor. So I usually run my pro formas out 10 or sometimes even 30 years, depending upon the type of property that I'm buying. However, we can't fit that on a screen easily. So we're going to demonstrate based on a 5-year ownership model. In order to figure out, now here's the first time we're going to start to talk about loans. And again, I'm going to go ahead and switch back over directly to the spreadsheet so we can look at all of these pieces. You'll notice I have a data input box up top. Everywhere where I'm highlighted in yellow, I need to put in information about what this property is like. And again, every property is unique. So I've included a purchase price, my estimation of the building value to the cost, and then we calculate the land value. I'm estimating that I can get a loan at 75% loan to value ratio here, which tells me that my loan is going to be a $750,000 loan, and my initial equity investment is going to be at least $250,000. There'll probably be some extras associated with closing costs that I've not included in this model, but they're simple to add. I'm looking at a 4.5% loan amortized over 30 years. There is a balloon payment in 10 years, which will not come into effect in this model because we're looking at a 5-year model. For tax assumptions, I'm assuming that the building can be depreciated over 39 years. This is typical for investment property. Your numbers may be different, and you need to talk to your accountant about what the depreciation period is. There are also some accelerated depreciation methods that can be used that increase the amount of depreciation in early years. This is typically a good thing. Again, it's a tax-free loan from the government. Ordinary tax rate will also be your personal ordinary tax rate. It might be 12%, it might be 24%, it might be 30%. It all depends on the tax laws in the years that you're working and your particular scenario. Depreciation recapture is at 25%. That's a fixed percentage at the time I'm doing this presentation, which is the beginning of 2021. And the capital gains tax rate is also your personal tax rate. It might be 0, it could be all the way up to 20%. We talked about cap rates in terms of sales price. I calculate the initial cap rate at 8% because my first year's net operating income is $80,000 and my purchase price is $1 million. 80,000 divided by $1 million is 8%. And typically, we estimate a higher terminal cap rate because we are assuming that the property will be in slightly worse shape after a certain number of years. For a 5-year pro forma, I'm probably going to increase the terminal cap rate by 0.5%. A 10-year pro forma, and I might increase the terminal cap rate by 1%. In order to figure out our estimate of what we're going to sell the property for, we need to know our net operating income in year 6. I did indeed calculate that on the NOI spreadsheet, and I've put it here for reference. We anticipate the net operating income in year 6 to be about $95,331. So we divide the terminal cap rate into year 6 net operating income, and we come up with what's called a resale or a reversion price of about 1.12 million. We expect to be able to sell this property that we purchased for 1 million for 1.12 million at the end of year 5. I've also estimated some selling costs, 6%, and in order to determine our net present value, we have to understand what our own personal discount rate is. I've put in a 10% after tax and 13% before tax discount rate for discounting purposes, and we'll see how this comes into play later. Calculating our before-tax and after-tax cash flows is a fairly straightforward endeavor. We take our net operating income and subtract that year's interest and depreciation. Note that I'm not subtracting the full mortgage payments because some of our mortgage payments go into principal and that becomes equity in the property. That money is not tax deductible, only the interest expense is tax deductible. When I subtract these two items from net operating income, I get our taxable income or loss, and then I calculate our tax liability based on the tax rates entered in the spreadsheet. This taxable income or loss is a before tax cash flow. To calculate what our after-tax cash flow actually looks like, we take the net operating income, we subtract out our total debt service because that's money going out the door, giving us our before tax cash flow. When we subtract our tax liability from that before tax cash flow, we end up with our after-tax cash flow. You can see that our after-tax cash flow differs and is higher than our taxable income, and that is typically due to depreciation. We've calculated our annual cash flows while owning the property, but for the 5th year, when we sell the property, we need to add in the cash flows from sale. This is a much more complicated process. We start by calculating the adjusted basis. We purchased the property for $1 million, and we have to subtract the depreciation that we've taken over the last 5 years. Our adjusted basis at the end of year 5 ends up being $891,000. Now we calculate taxes due on sale. The sales price minus any sales cost, which I had estimated at 6%, give us the net sales proceeds. We subtract from this the adjusted basis to determine what our taxable gain is. However, our taxable gain consists of two pieces, depreciation recapture and an actual capital gain. The depreciation recapture we've already calculated. When we subtract that from our taxable gain, we come up with our capital gain amount. We pay taxes at 2 different tax rates here. I've estimated that our capital gains tax rate will be 10%. So our capital gains tax is $5,400. And we know that our depreciation was $109,000, and we have to pay taxes at a 25% rate. That's $27,000. Our total taxes that we will owe after the sale are just over $32.5 thousand. Now we need to look at the cash flows. Our net sales proceeds were just over $1 million. We subtract from that the remaining mortgage balance because the mortgage has to be paid, and we come up with something called a before tax equity reversion or before tax cash flow. When we subtract out the taxes due on sale, we end up with the after-tax cash flow associated with the sale of the property. Now we're ready to determine the net present value and the internal rates of return on the property. We look at the before tax cash flows each year from our spreadsheet. We add in the 5th year's reversion or the cash flow from the sale, and we end up with the tax flows, our before tax cash flows. We spent $250,000 to buy the property. We get yearly cash flows from the property, and in the final year, our cash flow is $417,000. We can now calculate our before tax internal rate of return, 21.69%. Let's take a look at after-tax numbers. We start with our after-tax cash flows. We add in our after-tax equity reversion, and we end up with our total after-tax cash flows. We discount these at a slightly different rate, 10%, in order to come up with the present value of our after-tax cash flows. And we can look at our after-tax internal rate of return, which is 17.79%. I've also calculated our effective tax rate on what we've earned. It turns out to be approximately 18%. This is less than your standard tax rate because our capital gains taxes were lower than the 22% standard tax rate that I had in the spreadsheet. So now we can calculate our net present value. And it turns out that the after-tax net present value for this particular model is $82,827. Anytime you're dealing with a positive after-tax net present value, that's a project that you should probably undertake. It's important to remember that the ability to analyze real estate like a pro does not make you a pro. Only experience can do that. In my humble opinion, real estate can play a critical role in amassing long-term wealth, but you must be prepared for and be able to manage the hassles that come with it. Finally, financial modeling service can help you model your particular real estate project. In addition to analyses like this one, we perform loan analyses and sell versus hold and refinance analyses. Please contact us and let us know how we can help you. Thanks for listening.